Over the past few years, I've started buying this high-yield midstream oil and gas stock. That is Hess Midstream, ticker symbol HESM. This stock has been a surprising outperformer, and I wish I recognized it earlier. Over the past 5 years, this company has a total return of 192.1%, which is 23.9% annually. Since going public in 2017, the stock did not do well at all in its first few years. However, the all-time total return is still 176%, which is a compound annual growth rate of 13.2%. And that's not bad at all. Plus, this has proven to be an extremely high-quality dividend growth stock. It has a unique combination of high yield with high dividend growth that is difficult to find. The current yield is 7.37%, and the 5-year compound annual growth rate of the dividend is 10.49%. The 3-year CAGR is 8.93%. And you can see they raise their dividend payment every single quarter. So today I'm going to be doing a full review on HESM stock. That will include a deep dive into their business model, stock financials, future outlook, and news stories around the company. And if you stick around to the end of the video, I'll do a valuation with the dividend discount model and share analyst price targets. With that said, let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I will be using the stock research and portfolio tracking tool over at dividenddata.com. And right now is one of the best times to join. We have our summer sale where you can lock in 50% off membership for life. The link is in the description and pinned comment of the video. This will only be available for a limited time, so lock it in while you can. Hess Midstream is a midstream oil and gas company. This means they focus on the transportation of crude oil and natural gas liquids. They also have some water gathering pipelines, which is a smaller part of their business. The company's assets are primarily built around the Bakken Formation and Williston Basin. This is in the northwest of the United States, around North Dakota, South Dakota, and Montana, as well as some parts in Canada. And with these midstream oil and gas companies, I think the best way to build your understanding is with mapping it out visually. So on Hess's website, you can see all their different pipelines. For example, in yellow, we have their natural gas gathering pipelines. So this transports large amounts of natural gas liquids to their processing facilities. As an example, we have the Tioga gas plant here in A and the Little Missouri 4 gas plant here in G. And it also connects them to terminals so that after it's processed, they can then transport it out to different locations. As you can see, they have a large presence in natural gas pipelines. They also have crude oil pipelines, which is this like mint colored line. And they take that to oil processing facilities. And these terminals are pretty interesting. Often it's just connecting into other third-party pipelines, but then they also have large networks of trucks to transport it to various facilities. And at the Tioga rail terminal, they have a bunch of rail cars that they own. As an example, Hess Midstream owns 550 crude oil rail cars, but this terminal in general can handle 140,000 barrels per day of crude oil and 30,000 barrels per day of natural gas liquids. They also have a large storage facility at the location. And this is a big terminal with a direct rail connection to the BNSF Railway, which if you're an investor, you would know is owned by Warren Buffett's Berkshire Hathaway. And from there, it can get transported all over the country, and it has connections to other railroads like Union Pacific, CSX, Norfolk Southern, etc. But in the big picture, when you think about Hess Midstream, you got to think about energy infrastructure, and this is part of the process of transportation. So it's how they move it after gathering to then processing and storage, and then ultimately to terminaling and export. And Hess Midstream does large and growing volumes of natural gas, oil, and water. So how do these transportation-based companies actually make money? Well, they get fees for transporting the natural gas liquids, crude oil, and water. And this company has some contracts that give it very reliable growing revenue. And it's how the stock has become a cash flow machine that pays that growing dividend. So their largest customer is Hess. And if you couldn't tell by the name Hess Midstream, they actually have a large corporate relationship with them as well. I'll explain that later when I go through the weird corporate structure of the company. They just extended a long-term commercial contract with Hess, which is their number one customer. So they have deals through 2033. And when we get to that date, it would then be year by year, but they'll likely to sign another long-term extension. And with Hess, it's 100% fee-based contracts to minimize commodity price exposure. They also have minimum volume commitments, or MVCs, which is a guarantee of around 80% of their volumes. And here's some more details on that HESS contract. It eliminates risk from commodity price exposure, and it has inflation-based escalation. So those initial fees were set at an average rate for the period 2021 through 2023. So that's a pretty healthy inflation rate if we remember what was going on economically at that time. And it also has that fees cannot be changed or reduced once set. And this fixed fee model with Hess represents 85% of the revenue for Hess Midstream. So Hess Midstream will have very reliable and growing cash flows. And in the worst case scenario of volume somehow going down, they have a guaranteed 80% MVC. So even during bad oil and gas markets, the company's cash flows will remain steady. As an example, in 2020, HESM barely saw any decline and then continued its path towards growth. So before I get into the stock analysis, a look at the news and the dividend for HESM, we need to talk about their corporate structure and how this impacts things as an investor. In this 10K, they have a chart of their ownership structure, and I'm going to be honest, it's very convoluted. I spent a lot of time trying to understand this, and I'm still not sure I completely get it. So there's Hess, which is a oil and gas producer. They basically formed a partnership with investors to raise money to then build out these midstream assets. So they have a 50-50 partnership with this company, Global Infrastructure Partners and Affiliates. And they also have units in this partnership, Hess Midstream Operations. But the partnership is not what's publicly traded. That partnership owns this public company, Hess Midstream Limited Partnership. That's the ticker symbol HESM that you can invest in. And those shares are owned by the public and Hess Corporation, the ticker symbol HES. And if I didn't lose you yet, it gets even more complicated. Basically, over time, their investors, like Global Infrastructure Partners, have been selling their units in the partnership. And there's been this whole process of repurchasing, which then somehow creates more shares in the public company. And this is why if you go to look at the shares outstanding for Hess Midstream, it seems like in recent years, the share count is growing. I still find this detail to be somewhat confusing, but I did do some research, and Hess basically is saying that overall dilution has been offset by some of the buybacks. And they argue that those transitions are actually accretive to shareholders in the public company, and they now own more of the partnership overall. However, there's actually a bright side to this very convoluted structure. Normally, these publicly traded partnerships have a little worse of a tax situation where you get a K-1 tax form in the mail and it adds a few more steps. However, the publicly traded Hess Midstream, which trades under HESM, is structured as a UPC, which is an umbrella partnership C corporation, and it is not a master limited partnership. So shareholders of HESM actually get a 1099 div form, the same as you normally get with your dividend stocks, rather than a K1, which is typically associated with MLPs. So if you're a dividend investor who wants to avoid those K1s, this is a big plus for HESM. And shout out to someone in the YouTube comments who brought this up in a recent video. So those details were a little boring, but it is something you need to pay attention to if you're investing in HESM. And after all, this is a full stock review video. Now let's take a look at their financials and their dividend. And afterwards, we'll do a summary of their recent earnings report and their future outlook in the coming years, cover a few important news stories like Chevron's acquisition of Hess, and then do a valuation on the stock. All right, so Hess Midstream, current stock price is $38.54. It has a forward-looking annual dividend of $2.84, which gives it a 7.37% dividend yield. The current market cap is $8 billion. So this is a lot smaller than other midstream oil and gas stocks I cover, like MPLX and EPD. It is a quarterly dividend payer, which grows that dividend payment every quarter, and this is annually in a 9 to 10% range. Their most recent dividend increase was 1.23%, and in prior quarters, it has been in the 2 to 3% range. And based on free cash flow, this dividend is very sustainable with a 37% free cash flow payout ratio. It is over 100% based on net income, but net income can be a little iffy at times. Since at its core, this is a partnership, you have to view it through distributable cash flow. Overall, this dividend is safe. If you don't believe me, let's go back to the actual financial documents from HESM. HESM has more than enough free cash flow to support the distributions. As an example, in fiscal 2024, they had $655 million in free cash flow. And you can see right here, they had a lot of money left over after distributions. And they gave guidance expecting free cash flow for 2025 to be $735 million to $785 million. They also have mentioned countless times in their guidance and latest earnings report that they are targeting at least 5% annual dividend per share growth through at least 2027. It should also be mentioned that in prior years, they had the same 5% target increase, but they grew it more every single one of those years. As an example, from 2021 to 2022, they had a 5% increase on top of that. From 2022 to 2023, they had a 6% increase on top of that. And from 2023 to 2024, they had a 5% increase on top of that. So 5% is the base case for growth. They will likely beat that. And this company has a reliable track record of returning capital to shareholders. Since 2021, they've increased the dividends per share by 57% and completed an aggregate of $2.15 billion in share repurchases. They have also grown their EBITDA at a 20% compound annual growth rate. That's from 2015 through 2025. All right, so let's summarize the latest quarter for HESM. The big thing with this company is the volumes that they do through their midstream assets, and the growth is pretty impressive. Their gas processing throughput increased 8% year over year. Their oil terminaling throughput increased 7% year over year, and their water gathering throughput increased 9% year over year. And if you're wondering what percentage of revenue these business segments are, they don't directly disclose that, but I did do some math and used AI to come up with some estimates. And natural gas is estimated to be 75% of their total revenue, crude oil 15 to 20%, and water 5 to 10%. So I actually like the natural gas as one of the bigger segments because that's more of the growth business longer term. The company also repurchased $100 million of their Class B units in January 2025. And this is at that partnership level, which is why they're called units. Again, I went over that whole corporate structure earlier, and their outlook for fiscal 2025 was really good. They reaffirmed it in their latest quarter. And again, we're talking about at least 5% annual dividend per share growth. They're expecting volume growth across all their systems through 2026 and 2027. So overall, the company seems poised for success. And if you're wondering what that 2025 guidance was for the volumes, that's at least 8% on the lower end for gas processing, at least 5.6% for oil, and basically no to minor growth in water gathering. Now, if you're watching this video and you know a little bit about Hess, which I mentioned is directly related to Hess Midstream, they're in the middle of a merger with Chevron. Chevron put in a bid to acquire Hess Corporation in a $53 billion all-stock deal. However, this has been in limbo basically for a number of years now, but it's expected to be resolved by August 2025. And this acquisition will not directly impact Hess Midstream at all as they are a separate company. And the crucial things you need to understand is that Chevron will then inherit all of Hess's contracts with Hess Midstream, and those agreements will remain in place through 2033, no changes. That was mentioned in their 10K, and that Chevron acquisition could actually be bullish for Hess Midstream over the long term. Chevron is a much larger company than Hess, so they could actually invest and expand those operations in the Bakken Basin, and I assume that strategic position was a big part of their logic for why they made the acquisition. So at a minimum, this probably doesn't hurt Hess Midstream at all, and it could actually increase the potential of a positive outcome. All right, now let's do a valuation on Hess Midstream stock. And for a company like this, the dividend is such a big part of their return. So I am going to be valuing the stock based on the dividend discount model. If you want to use the calculator I'm going to show, it's in the extra tools segment on dividenddata.com. And it's a very simple calculator with 3 options: the Ben Graham calculator, the DCF calculator, and the dividend discount model. And basically this estimates the present value of all the future dividends a company will pay. And the big assumptions you put in are the growth rate of the dividend, and then the discount rate, meaning the expected return you want. And you could fill in a lot of different things for that. I like looking at it as opportunity cost, so I tend to put it around 10% or around what the S&P 500 does. So let's enter the current share price of $38.57, the dividend per share of $2.84, which is the current forward-looking annual dividend. And then for the growth rate, we will do a few different estimates, one very conservative and then one a little more aggressive. So let's start with the conservative one. We'll put it at 5%, which is the guidance they give. And then we'll say we are looking for a 10% annual return, so a discount rate of 10%. And you can see here, this gives it a present value of $53.81, which implies the stock is undervalued by 28.33%. And if we assume just a 5% dividend growth rate, which is likely because that's way below what they've been doing recently, and if we raise the discount rate to 12%, it still shows the stock is undervalued with a present value of $40.91. So let's do 2 other cases, one with the dividend growth rate at 7%. We'll go back to that 10% discount rate. That gives it a present value of $75.88, which is undervalued by nearly 50%. And if we want a 12% discount rate, the stock is still undervalued by nearly 30%. It remains undervalued all the way up to a 14% discount rate, just assuming 7% dividend growth. And if we do 9% dividend growth and a 15% discount rate, the stock is still undervalued by nearly 19.7%. So overall, if you're a dividend growth investor, I would say HESM, even at today's stock price, has a large margin of safety. This is a smaller stock, so it doesn't get a lot of coverage, but currently there are 5 estimates among Wall Street analysts, with the mean price target at $44 a share. The highest price target is $48, and the lowest is $41. 2 have it ranked as a hold, 2 as a buy, and 1 as outperform. So overall, let's look at my position in HESM. I have 204.21 shares. I am buying the stock right now. I have been buying it over the past couple months, and I will likely continue buying it as long as it remains at attractive prices. I wish I knew about it many years ago, but I still think it's quite attractive at today's prices. The company pays me $579 in annual dividends, and I look forward to building this up as a core position of my dividend growth portfolio. But all of that is just my opinion. You should do your own research before making any investing decisions. Do not just follow what I do blindly. I'm just sharing my own investment journey here and giving you my thought process. If there's any interesting details about HESM you think I missed out on, please leave a comment below. Also leave a comment if there's any more companies you want me to cover. Thank you for watching this stock review video. Please leave a like, comment, and subscribe to the channel. And if you want to use the research tool I showed throughout, all of it's available at dividenddata.com. We do have our summer sale live right now where you can lock in 50% off annual membership. This is the best price we ever offer. If the tool helps you find just one better stock, then way more than pays for itself. Feel free to try it out. There's a 30-day money-back guarantee. The link is in the description and pinned comment of the video. Thanks for watching, and I'll see you in the next one.